Taste Holdings has investments in two main divisions, National Wholesale Jewellery and a food division trading as Scooters Pizza, Maxi's, St. Elmos and the Fish and Chips Co. It has a market cap of 773 million rand, a price to earnings ratio of 29.7 and a dividend yield of 1%. And I know Taste Management is getting really irritated with me, but I still can't see how they've got these very diverse operations, the jewellery division and a fast food operation, but it's working.
It is working. The share price is doing very well, as you can see that. You could have bought them for 9 cents, I think, or something like that, something terrible of that sort. Now it's much, much higher. Look, it's a franchise operation. That's how they explain it. In other words, centralized wholesaling and then retail support and support of franchises.
So they could, for instance, go into car parts in a franchise.
Clothing next, car parts, any such thing. And I think, to be fair, that might work. There are some international examples. But I think what's lighting this one up is partly the fact that the jewellery division has done fine and continues to show very high margins, albeit relatively slow revenue growth. And then on the other side, the food division has got the same positive characteristics.
Let's get your thoughts on this model and how it differs from the other two companies we've been discussing, namely Spur Corp and Famous Brands.
So the glaring difference is the jewellery offering. Now, food and jewellery aren't related, in case anyone thought that they were. Like Paul says, it's the focus on the franchise offering. I don't think the guys went out specifically looking for a jewellery offering, but they saw the franchising opportunity behind NWJ, and that appealed to them.
If you look at the two components of the business, does NWJ do better than the food component, the St. Elmos and the Maxis, etc.?
Well, the majority of the income now is coming from the food side, especially after the acquisition of the Fish and Chip Co. That firmly put them back in place of a food franchise business. At one stage, they were looking a little bit half-off. You weren't maybe sure where it was going to go. But the Fish and Chip Co. was an excellent acquisition, put them firmly in that food footings with a specific focus on the lower LSM, and that's where they are.
So, Paul?
That was a brilliant acquisition. Also a bit of a fight with the guys they bought it from, but Carlo Gonzaga, the CEO, seems to have sort of warded that off. Brilliant acquisition. Why? Because it's targeting a very high growth market, which is that sort of takeaways, but not sort of sit down really. Large portions of fries and then protein in a sort of newspaper square type delivery option.
Sounds as though you're familiar with the offering.
Yes, absolutely fabulous. The other one that's in that space is Hungry Lion, which is the ShopRite thing.
We both love that brand. We've often commented that Hungry Lion just does it for me.
So I think this one is going to be a real money spinner for them, and it means that it's also a cheaper franchise option. So it's available to people that don't have quite as much capital to get going and get started. I suspect they'll continue to do fine. Maxi's has been through a few renewals. St. Elmo's has a certain spot. Pizza remains a very solid growth area where middle-class people are sort of discovering pizza and liking it more and more. Having said that, all of these groups suffer a little bit from being a bit weak in the chicken area because of Nando's, KFC and Chicken Lick and being, separately and differently owned.
NWJ, do you see it remaining within the fold?
I suspect so, because they've even gone so far as to buy out some of their other franchisees. The Rabinovitz family that they bought it from was involved in the business, but I think they've now gone non-exec, so it certainly looks as though they're working on it. Having said that, American Swiss Stearns, which belong to Foschini, so if they ever did want to sell it, I'm sure there'd be plenty of potential buyers.
Well, if they've spent their time perfecting their franchise model, what else do you think they'll pull into the franchise fold then, if we say that they can go anywhere, basically?
In terms of different categories?
Different categories.
Look, I personally think they're going to stay in the food business. I think food makes possibly the most sense from a franchising point of view for them. And like I said, I think they went into jewellery not because they were looking for jewellery, but because they were looking for great franchise opportunities, and this just happened to be a great franchising opportunity, and it happened to be jewellery. They have made a great go of it. They own about 30% of the stores, the rest are franchised. The stores do very well. They're going to introduce a credit offering there. But I think if you're going to see any further acquisitions, it's going to be food. That's what I say.
Isn't this the one that's just begun the route of doing the centralized supply of its ingredients that you were referring to?
So as I said in the beginning, one of the guys has just started off with that centralized distribution. That's Taste. And it's very exciting because, while the other guys have been doing it for a while and you've seen quite a few of the benefits coming through, Taste is just starting off on that.
So they're about to reap those benefits.
So at the moment, not only are you not seeing the benefits, but you're seeing the costs with starting up. So the current earnings are actually depressed by the cost of starting up this massive part of the business, and you're going to see more and more benefits come through as they get more and more used to the whole operational change and operational advantage that comes with that.
If you look at the graph at 5 Rand, probably their all-time high. What's got
I
it
think
to
it's
that
like
peak and then
360 or so. Well, look, it's interesting because it listed at around 1 Rand back in 2007, and then it did quite nicely to start with, and then it collapsed to a few cents in that slump of 2009. So really, maybe not 9 cents I said earlier, maybe it was about 40. And then no one cared, really.
I'm
it
not
was
sure if you
totally
did
lost.
any research for today's show. Just excuse him, Daniel.
I'm remembering share prices from 2007. What do you want?
All right. No,
So then
still
it just
impressed.
suddenly catches a wake up here by 2012 because the economy is turning and the mood is, and everyone who owned them back then is forgotten. And everybody says, wow, look at this great share price. It's going up. So there is a little bit of that. It's always been a bit thinly traded. Partly, I guess, because it's quite tightly held. The management's got a nice stake, though. I just think it can continue to do well, and it trades higher. But that's what happens with stocks like this. Then the turnover starts to increase because it's been more widely owned.
Hot or not, Daniel?
So I think that this stock out of the three has the best earnings growth profile. I think they're going to be able to grow earnings the strongest. I also like the CEO a lot, Carlo. I think he's a fantastic personality, especially for the franchising business. So I'm happy to back him. So I'd say hot.
Hot or not, Paul?
Yeah, Carlo can be a tough bastard when it comes to dealing with his lower, franchisees. I know this, but I think that's sometimes what you need for dealing with those kinds of people.